the 60/40 is certainly not dead or some derivation thereof for most advisors. It is the benchmark or foundational portfolio for a variety of different reasons. One, because it sort of is structurally something that has been compelling for many decades, and two, we have to recognize that there's elements of pure risk that exist in that business. And someone said, these folks are running a business, which we have to appreciate, which I absolutely do. And so I think the question from their seat is, where are there good bang for the buck opportunities to help improve, diversification without taking on too much peer risk, right? Because that's a real thing that they have to take into consideration for their client base. And so when, at some level, it's a pretty straightforward set of thoughts. There's three assets in the world, three return streams that would meaningfully improve the return relative to the risk that a portfolio manager is taking on. And that's gold, diversified commodities, and low-cost alpha strategies. Those are the three things that you can add to your portfolio that will help meaningfully. And so as a simple example, if you added, gold, there's obviously easy ways to do that. Diversified commodities, there's easy ways to do that. Diversified, what I call sort of diversified alpha or balanced alpha, which are, low cost structure, it's trend following, the variety of different trend following strategies. It's other alphas that maybe come from equity long short or fixed income alphas, things like that. If you were to take 10%, you take your 60/40 portfolio, put 10% in gold, 10% in commodities, and 10% in diversified or balanced alpha, you can get a 50% improvement. If you just look back through time, it's a 50% improvement in the Sharpe ratio of your portfolio, but you're still maintaining something like, above 90% monthly correlation to the 60/40 portfolio. That's a pretty compelling story, right?